Hello and welcome to my Trading 212 Stocks and Shares ISA portfolio update for February 2025. And what a month it has been. January was all right. It was a bit up and down, but overall January turned out okay. But the same definitely can't be said for February. We have seen a bit of a downwards trend. So before we jump into looking at my portfolio, let's quickly go through the market news and see what exactly has happened. So we'll start off with the S&P 500, and as you can see here looking at this chart, over the past month it is down by 1.42%. However, UK investors will have experienced a much more significant decline than that. Looking at the Vanguard S&P 500 ETF as an example, just because it's the most popular ETF for UK investors to invest in the S&P 500, we can see that is down by nearly 5% over the past month. Now, there's a few reasons for this, but one of the key reasons is because the pound has strengthened against the dollar, and when the pound strengthens against the dollar, S&P 500 ETFs or any ETF containing American stocks that are listed in Great British pounds, that will have a negative impact on its performance. There's a few other reasons as well why the performance might differ, but the key thing to remember is you're not investing in the S&P 500 directly, you're investing into an ETF that tracks that index. Turning back to the S&P 500 more generally though, to explore a few reasons why this has happened, first of all, we can look at the recent earnings reports. So Nvidia, yesterday at the time of recording, released earnings, and although there was nothing too bad in there, investors were a bit underwhelmed. According to this article by Reuters, although there was an upbeat revenue outlook, investors were a bit disappointed by the forecast for gross margin. And generally, when Nvidia declines a bit, so do other tech stocks, especially other semiconductors. And if we look at a year-to-date chart for Nvidia, we can see, although it has had an incredible couple of years, year to date, it is down by nearly 10%. Who knows what will happen going forward? I make no predictions about the market and definitely no predictions about individual stocks on this channel. The next reason for the decline in the S&P 500 and American stocks is, of course, the Trump tariffs. All the talks about tariffs on Mexico, Canada, China, and maybe even some European countries. Tariffs are inflationary, they impact competitiveness of companies, and of course, a decline in global trade is not really good for global economic growth. To put things very simply, of course, there's a lot more that could be said there. There's also been some general concerns regarding the US economy after some data came out showing rising unemployment claims. So when you put that on top of all the other reasons, this has all led to not a very good month for the S&P 500. And then there's also the geopolitical tensions regarding the Ukraine war. And I'm recording this on the night of that heated meeting with Trump, Vance and Zelensky. I'm not a politics channel, so I'm not going to comment on that. All I'll say is that was a bit of an uncomfortable watch. Turning away from news though, I do want to take a quick look at the valuation of the S&P 500 because I do think this is a reminder that US stocks are very expensive from a forward price to earnings perspective. They're pretty much as expensive as they were in 2021, which was followed by the 2022 tech wreck and that big decline. Of course, I'm not saying that's going to happen again. I'm just saying valuations can't go up forever. And eventually there probably is going to be some form of reversion to mean or maybe a downwards movement of some kind. And this might be it, it might not be. But to understand the poor performance, the valuation is important because when valuations are so high, there needs to be constant good news to justify those valuations. Moving on from the US markets, we'll now look at the European markets and I'm going to look at the Euro Stoxx 50. And we can see this is a completely different story. This is having an incredible year to date, up 11.1%. So although your global index might be down, it is the US component which dominates the index that is dragging it down. European stocks are doing incredibly well. And one European stock in particular that isn't actually in the Euro Stoxx 50 that is doing very, very well is Rheinmetall. So this is a German defense company, and it's unsurprising really this is doing so well with all those geopolitical tensions. So I personally am going to be keeping an eye on Rheinmetall. It's up 66% year to date. And I'll be interested to see what happens on Monday when the markets open after that very tense meeting with Trump, Vance and Zelensky. And finally, turning to the UK, we can see the FTSE 100 is also doing well year to date, up by 6.65%. So again, it's only really the American component of a global index fund that is dragging things down. European and UK stocks are doing okay. The market, of course, does constantly change, so this could flip in my next portfolio update. Now, before jumping into my Trading 212 portfolio, don't forget that if you are new to Trading 212, you can get a free fractional share worth up to £100 by signing up through the link in my description. Alternatively, within 10 days of opening your account, you can use my promo code TOM in the menu page of the app. If you do use it, let me know in the comments below what you get. And thanks to all those who have used any of my links in the description. It's a great way to support my content and I really do appreciate it. So here we are in my stocks and shares ISA on Trading 212. So as you can see, the rate of return now is 12.4%. Total return, £1,376. It's obviously a big decline from last month. The value of the portfolio now stands at £14,876. If we just turn to the 1 month view now, you can see that it is down by £569 over the past month, or minus 3.8%. Now, as a long-term investor, I don't even flinch at this, but on this channel, I find it super important to show the bad months as well as the good months. The stock market doesn't always go up. There is volatility, there is negative months, negative years, and you have to be willing to ride out this volatility and have a long-term mindset to be a successful investor. Switching back to that maximum view, you can see my rate of return is 12.4%. So this is a cumulative rate of return. And because I started this ISA this tax year, that is my cumulative rate of return since I first contributed on the 6th of April or whenever it was. However, if we use the XIRR function on Excel to calculate my internal rate of return, that is slightly higher. I'll put it on screen now. And the reason why that's slightly higher is I believe the XIRR function gives an annualized rate of return. And because it's been slightly less than a year, it's been 10 or 11 months since I contributed to this portfolio, that is why the XIRR rate of return is higher than the one that Trading 212 displays. Cumulative versus annualized. Now, scrolling down, there's no changes to the portfolio in terms of positions. It's just JP Morgan Global Growth and Income, SPDR MSCI USA Small Cap Value Weighted ETF, bit of a mouthful, and then the one individual stock, Bloomsbury Publishing. Let's go through these one by one. So JP Morgan Global Growth and Income, that is down by 3.5% over the past month, so it's not doing too well. What I found with JP Morgan Global Growth and Income is because it is a bit more concentrated, and it doesn't track an index, of course, it's an actively managed investment trust, it does fluctuate by more than a global index fund for comparison. Just because it is more concentrated, it makes sense. So we can see I hold just short of 2014 shares. The return is plus £309.62 or 2.73%. Now remember, this return figure is diluted whenever you top it up because it's not money weighted, this return on individual stock. It's just a simple return calculation. So when you're in the green on a stock, if you top up that position, this will be diluted, this return figure. And also it doesn't include dividends, and dividends are a significant part of the total return of JGGI. Speaking of dividends, you can see an upcoming event. It does go ex-dividend on the 6th of March, so next week, for 6p per share, or just short of 6p per share, I think, and it'll be paid out on the 9th of April. So in April, I can expect quite a chunky dividend. I'll work it out in the editing and put it on the screen now. It's going to be a nice dividend to receive. Going back to the USA Small Cap Value Weighted ETF, we can see that has also done poorly over the last month, 5%. So small caps are more volatile than large caps usually. So if large caps are in decline and there's economic uncertainty and geopolitical tensions, small caps usually do decline more than large cap indexes. I currently own 40 shares, that is up by 5.57%. Now, the reason why I have this ETF, despite the fact it trades in US dollars, is because it was the only small cap value ETF option on Trading 212 or in general in the UKITS ETF market. However, as I briefly mentioned in the last update, there is now AVSG that I will be looking into, the Avantis Global Small Cap Value, because now we have a small cap value fund that trades in pounds. So there won't be any FX fees to pay when buying or selling. But I haven't made any decisions yet. It's just something I'm looking into. Then, of course, lastly, Bloomsbury. This has also had a poor month, so there's a theme here. It's just been a poor month for the portfolio in general. It's down by 6.7%, and I haven't really seen any news as to why this particularly is down by so much. I don't think there's been any negative Bloomsbury news. I just think it's general volatility for the market. I have 178 shares, up £81 at the moment, average price 564p, and I will keep on holding on to it. It's my one individual stock. I'm happy with dealing with the fluctuations, and that is why it's such a small part of the overall portfolio. Quickly looking at the asset allocation, we can see JP Morgan Global Growth and Income makes up 78% of the portfolio at the moment. Then the small cap value ETF, 14%, Bloomsbury, 7%. So what I'm thinking with my portfolio going forwards in the new tax year when the allowance resets and I can actually contribute more to this ISA is what I'll do is I'll probably buy a global index fund to counteract the fact that I've got a massive weight to an active investment trust in here. The reason why I've been happy to have such a great weighting to it is because all my investments in my Invest Engine ISA and Invest Engine SIP are all passive. So I was happy to have this bit of an active strategy in here, but I won't be focusing on growing this too much more. I'm happy to have it there, but I do want passive investments to form the vast majority of my portfolio, and that's what will happen in the new tax year when I can finally contribute some more. So that's my Trading 212 update, and the last thing I wanted to show in this video is that overall my portfolio, tracking everything, all my different ISAs and SIPs and a tiny bit of crypto, is slightly still up year to date by 0.5% using Getquin here to track the aggregated performance. I do have a link to Getquin in the description below if you want to check it out. It is a handy way to track all your portfolios in one place if you do have multiple accounts like me. Whilst it is showing slightly in the green by 0.5%, and these are live prices that change even after the market closes. You can see here, this is giving me prices up until the time of recording, live prices there. Switching back to that year to date, you can see there has been a significant decline in the last couple of weeks of February. I will reveal what's going on in my Invest Engine accounts in that update next week, but that is it for this update. The key messages are, as a long-term investor, I'm not sitting here panicking. It's part and parcel of investing. You have to deal with volatility. It doesn't always go up. And the reason why stocks outperform bonds and cash over the long term is because there is a risk premium. You're taking on that risk, so you expect high returns. And this is that risk in action. Stocks don't always go up. If you enjoyed this video, please consider leaving a like. And if you're new to the channel, consider subscribing because I do have a lot of interesting videos planned. And of course, my Invest Engine portfolio update will be out next week, so you can get a good idea of my overall portfolio. In the meantime, I'd recommend checking out these two videos here where I go through all the things I think need to be considered when picking between ETFs. As always, thank you for watching.